Welcome to lesson 2 in your Demystifying the Stock Market digital course. Welcome back. All right, so in lesson 2, we're going to cover understanding market basics, and we're going to discuss basic market terminology. So these are some of the things you need to start understanding as you start to establish your trading business. All right, let's get started. And just continue to follow along in your workbook as well, because there are corresponding pages to the topics that we discuss. All right, so first we're going to discuss stock market basics. We're going to talk about how the market works and some of the things you need to understand in terms of placing an order, bid and ask, et cetera, et cetera. And then we're also going to go over basic market terminology. There's a lot of terminology that's used in the stock market. We're going to give you about half a dozen definitions just to get you started with some of the terminology that's used regularly. All right, so the stock market itself. Understanding, where your money goes when you place that order, right? So everybody, you place an order and you wonder where that money goes, and you're hoping that, by tomorrow you have a little bit more money than you had today. So it's definitely not magical by any stretch. The stock market is built on what's called exchanges. So the exchanges are where the stocks trade. They are physical in nature, even though most trading has gone, pretty much electronic nowadays. The old school stock market, you would see down in what they call the trading pit. You would have all of the brokers down there flailing around, screaming prices and throwing paper around. And that was pre the days of electronic trading. There is still floor trading. There is still a pit, but it's definitely not what it used to be even 10 or 20 years ago. So the type of exchanges that we have here in the U.S., we have the New York Stock Exchange, the oldest exchange that we have, known as the NYSE. It's also known as the Big Board. So you have the New York Stock Exchange. Then you also have the American Stock Exchange, the Amex. So those are your two exchanges. There is a third exchange, which is the electronic trading floor, also known as the NASDAQ. A lot of the tech stocks are traded on the NASDAQ. There are also a lot of other companies that aren't necessarily tech companies that are traded on the NASDAQ as well. So when you place a trade, depending on what stock you are buying, will determine which exchange your stock will be coming from. All right, next let's talk about ticker symbols so that you understand how stocks are identified. So a ticker symbol is a few characters that identify a company on the exchange. So when a company is privately held and makes a transition and becomes a publicly traded company, it gets assigned a ticker symbol. Facebook is a great example. So when Facebook was a privately held company, it had no ticker symbol. Once it became publicly traded, it was given the ticker symbol, and they got the ticker symbol FB for Facebook. At the time of this class being recorded, Facebook has transitioned to become Meta, and so the ticker symbol is now META, Meta. But that's a great example of a privately held company transitioning to being publicly traded and getting its ticker symbol assigned. Now, a three-letter symbol typically means that the stock trades on the New York Stock Exchange. Now, the reason I say typically is because that is not a hard and fast rule. It is very possible that a company is traded on the NYSE and does not have a three-letter symbol. Ford is a good example. Ford trades under the ticker symbol F. Boeing trades under the ticker symbol BA. So, again, just because it doesn't have three letters doesn't necessarily mean that it's not traded on the New York Stock Exchange. Now, a four-letter symbol typically means that the stock is traded on the NASDAQ. Apple's a good example. Apple trades under the ticker symbol AAPL, Apple. So that's one way that you can start to determine where the stock might be traded. The other way you can determine where a stock is traded is going to be on your trading platform. I use TradingView. And so when I punch in DR Horton, one of the home builders in the U.S., it tells me it's traded on the New York Stock Exchange. And when the screenshot was taken, it does not provide the ticker symbol itself, but it does when you're actively using the platform. So DR Horton is a stock that is traded on the New York Stock Exchange. All right, let's talk about sectors. Why is it important for you to understand sectors, know how to identify and look at sectors, and include this as part of your overall trading strategy? So in becoming a successful stock market trader, part of your strategy needs to be becoming what we call a top-down trader. So when you trade from the top down, it means that you are trading first and foremost by looking at the general direction of the market and going with the market, not against it, right? So if the market is trending up or in a bullish pattern, you would want to trade bullish. If the market is trending down or in a bearish pattern, you'd want to trade bearish. If the market is channeling sideways and very choppy, you may want to continue sitting out of the market for a little while until the market gains a direction and some momentum. So from a top-down perspective, you want to take a look at the direction of the market. It's really akin to, trying to swim upstream against a current, right? It's more difficult, it takes more energy. The same thing in the stock market. If you're trying to trade in a direction, you're trying to trade a stock in a direction that is generally going against the overall market sentiment, you're going to have a much harder time having that trade become successful. So the sectors is the second layer of what you want to look at in terms of a top-down strategy. So you may decide you want to trade Google. So it's going to be important for you to understand what sector is Google in and how is that sector working right now. Is money coming into the sector? Is money coming out of the sector? What's going on with that sector? What's the sentiment in that sector? What are the big institutions and other big money players doing? So, because while a trade may set up from a technical standpoint and look good, if that sector is looking weak, that may be a reason that you pass on the trade. So there's a lot of different criteria that you'll be looking at when you decide whether or not you're going to actually execute on a trade. So let's talk about sectors. You have communication services, consumer cyclical, consumer defensive, industrials, real estate, energy, and so on and so forth. So this here is a heat map, and it's in a tool called FinViz, which we'll talk about a little bit later. But this heat map here gives me all of the sectors that are in the stock market. Now, on the day that this screenshot was taken, you can see it's all red. This heat map is red because this particular day, the stock market was selling off actually quite substantially. You can see Amazon was down almost 15% for the day. So here you can take a look at by sector, what's going on, and is that sector having a positive day or a negative day? So from the sectors, then you drill down to the subsectors. Each sector has a set of subsectors. So under communication services, you have internet content and information, entertainment, telecom services, electronics. Okay, so under internet content and information, you have Google and you have Facebook. There's more, but those are the two big ones. Under entertainment, you have Disney, Netflix, Charter Communications. Under telecom services, you have Verizon, T-Mobile. So these are the companies that sit in those subsectors. So being able to look and identify the sectors and then looking at the subsectors is important as part of your top-down trading strategy. Let's talk now about the market maker, the bid, and the ask. So this applies to when you are ready to actually place a trade. So the market works very much like it's a brokerage, right? There's a buyer and a seller, and there's a market maker in the middle. The market maker's job is to marry up the buyer and the seller. So anytime you are going to purchase a stock or sell a stock, or anytime you're going to purchase an option or sell an option, there's going to be a bid and an ask price. The ask price is what the seller is hoping to get for that sale. The bid is what you would be looking at if you were the seller. Now, there is a difference between the bid and the ask. In this example, the bid is $3.25. The ask is $3.75. The difference between $3.75 and $3.25 is what we call the spread. The spread here is 50 cents. So if you decide that you want to place a limit order, and we'll be talking about limit orders here shortly, if you decide that you want to purchase this stock or this option and you want to place a limit order, what you do is you place the order within the spread. You split the difference so that hopefully you don't pay $3.75. So you could put an order in for $3.50. Doesn't mean the order is going to be filled. Doesn't mean the order is going to be accepted. Doesn't mean the order is going to be taken. But it's certainly worth the try to try and purchase that for 25 cents under the asking price. If you get it, great. If not, then you have to reevaluate and decide if you want to move your asking price up a little bit. So those are the fundamentals to bid and ask and the approach of splitting the spread. Okay, let's talk about market terminology. So there's a lot of different terms for the stock market. These are some of the terms that are most commonly used and that you definitely need to understand as a starting point to your education in the stock market and starting to establish your swing trading business. So bullish. Now, if you are bullish, it's when a stock or the market in general is moving up, it is said to be bullish. Bearish. And that is when a stock or the market in general is moving down, it is said to be bearish. To open a trade. That is when you enter into a position into a particular stock or option. So if you want to purchase Apple, you'll be entering into a position into Apple. So that will be the opening of the trade. Closing a trade. That's going to be when you exit out of a position in a particular stock or option. So as you close out a trade, that's the point of exiting out of it. You no longer own that equity or that option. Filled. The term filled means that the order to buy or sell a position has been completed. So this is what happens after you place the order and the broker accepts the order and is able to either buy or sell your stock or buy or sell your option. Once that transaction is complete, that order is considered filled. Executed, the completion of a buy or sell order. So filled and executed really go hand in hand. You'll hear those terms used interchangeably. Long. You are long in a position when you own the stock or option. So if you purchase Apple stock or if you purchase calls on Apple, you are long the stock. Short. Borrowing shares of stock from a broker-dealer and then selling them on the open market is a short position on the stock. So one of the reasons you're probably taking this course is because you have heard that you can make money when the market goes down. So, historically, we are trained to believe that only when the market goes up, that's the only time to make money, and it's only good if the market's going up. I mean, we are trained that way from as far back as I can remember. And unfortunately, when we hand our money over to financial planners and put our money into 401ks and things like that, those portfolios only grow when we're in a bullish market. In order for you to make money when the market is going down, you have to control your own portfolio. You have to manage your own money because those entities, those 401k portfolios, those financial managers are not going to do that for you. So learning to short the market is an important way for you to take control of your financial freedom. So in addition to shorting a stock by purchasing the stock and then selling it on the open market, the other way that you can take advantage of shorting is by purchasing put options. So if you have a stock that is going to be trending down and it meets all the criteria for a trade, you don't have to purchase the stock to short it. You can purchase put options and take advantage of that stock going down. More of that will be discussed in future courses. All right, now let's talk about the types of orders so that you understand when you go into your brokerage platform, what types of orders are going to be available to you to utilize. And you will have to choose what type of order is best for your transaction. So we're going to start with a market order. So a market order authorizes your broker to buy or sell a stock or option at the current quoted price when a trade reaches the trading floor. And again, keep in mind, this is all done electronically. So whether you're using Robinhood or whether you're using Webull or you're on Thinkorswim, all of this is done electronically, but the concept is still the same. So you put the market order in, and what you're doing is you're telling your broker you can buy it at whatever price. So we really do not recommend utilizing market orders because control is taken away from you as the trader and places control completely in the hands of the broker, the market makers, and the floor traders that are controlling the flow of the orders. So now the only time you might want to consider using a market order is if the market is running on you and a quick exit is necessary, but that has inherent risks as well. And hopefully if you are following a tight trade thesis and you are utilizing good principles of risk management, hopefully you are not finding yourself needing to exit the market in a hurry. Next, limit order. Using a limit order to place trades will allow greater control of your buy and sell orders. A limit order will give your brokerage platform a set price at which to buy or sell that stock or option. So for example, you want to buy 1,000 shares of a stock at $30 a share. You would set a limit order for $30. Now you have told the system that you will pay $30 or less per share for stock XYZ. No more. You won't pay $30.01. You will pay $30 maximum. You'll pay less than $30. That's okay if they want to get it to you for less than $30, but you will not pay more than $30. Day order. A day order is an order to buy or sell a stock or option that is valid during that trading day. So if the order is not filled by the close of business on that trading day, the order is automatically canceled. So the question becomes is when would you want to use a day order? Well, a good time to use a day order is if you want the ability to reassess your trade thesis the next day, especially when markets are highly volatile and things are changing day to day. A trade thesis that looks good today may not look good tomorrow. So you put your order in, you put your day order in, it doesn't get filled. It doesn't get filled for whatever reason. So a good example is this. Trading a particular stock called QID, having a order entry point of $24.60. Now, when the trade setup happens, the QID is trading at $23.90. And the trade thesis tells us at $24.60, the trade now makes sense for a variety of different reasons. So you could put your order in for $24.60 and put it in as a day order. And if the stock hits $24.60 within that trading day, your order will get filled. If it doesn't, then that order evaporates, and the next day the order no longer exists. But say you wake up the next day and something has happened overnight news, and the futures are down, and the stock market sells off the next day. Now, you wouldn't want to have that order enter itself on the next day. Say the market opened up and gapped up and then sold off for a variety of reasons. You wouldn't want that order to get filled when circumstances have changed. You'd want the opportunity on the next day to reevaluate the landscape and what's going on, and then decide if you wanted to keep that order open, or open a new order, I should say, for that trade. Okay, let's talk about good till canceled, also known as GTC. A GTC order authorizes the broker to buy or sell a position at a particular price at any time prior to the cancellation of the order. Now, typically, a GTC order is going to sit in your brokerage platform for 60 to 90 days. And if the order is not filled at the end of whatever that time frame is, it is automatically going to be canceled. Now, make sure that you check out your GTCs in whatever trading platform you decide to use, because all of them have different policies. So it's up to you to learn what is the policy of the brokerage firm that you're with and how long will they keep a GTC order open for. Stop loss. It is advisable to protect loss potential by entering an order that will stop the trade if the stock or option trades at a certain price. Excuse me. A stop loss order is such an order. Be aware that a stop loss order does not protect from gaps. Excuse me. If a stock or option gaps past your price and opens lower, you'll be taken out of the trade at that lower price. So let's talk about gaps for a moment. So when a stock opens up the next trading day, sometimes they tend to gap, meaning that they will jump from, say, $10 to $12 when it opens, completely bypassing 10.01 to 11.99. So same thing can happen on the downside. Stock may open up, may close at $10 one day, the next day it gaps down and opens at $9 or $8. If your stop loss is at $10.90 and it gaps down to $8, it blows right past your stop loss. Now, the system will sell your stock, but you're not going to get out at $10.90. You are most likely going to get out closer to the price that it gapped out at in the $8 range. So while stop losses are a good tool to utilize for risk mitigation, they are not the end-all be-all to managing the risk if the trade goes against you. Stop limit. A stop limit order is also a means of protection from extended losses. The difference between a stop limit and a stop loss is that a stop limit order will only sell at the limit price and not at a lower price. So if you put a stop limit order in at $10.90 and your stock gaps to $8, it will not liquidate your stock. So you'll still be in that trade, and then you will need to decide if you're still going to exit that trade at the $8 price point, or if you're going to continue to hold on to that trade. Contingency orders. When you place a stock or option order, you can choose to place contingencies on that order, meaning that the order will be filled only when a specific event has occurred. So for example, if you decide you want to buy Apple stock at $160 a share, and it is trading at $150 a share today, you can put a contingency order into your system that says, when Apple stock hits $160 per share, I want to purchase 100 shares of Apple stock. So your order will not be triggered until Apple hits $160 per share. Conditional order. When you use a conditional order, it allows you to place both your GTC, which you can utilize as your profit target, and your stop loss into the system at the same time. So what you've done by doing this is you create a safety net around your trade. So let's say you purchase a stock at $20 and you want to exit at $23. You would put a good till canceled or GTC order in for $23. You would also put a stop loss in for wherever your stop loss needs to be set. So say you would want your stop loss at $19 a share. If the stock drops $1 a share, you are out of the trade. So you would set your stop loss at $19. This allows you to, this is one of the ways that you start to manage your emotions, because you have your risk parameters in and you've set up your safety mechanisms for profit and for loss ahead of time before the event actually occurs. Trailing stop losses. Using a trailing stop loss allows a trader to maximize profits on a stock as it continues to trend. It's analogous to raising or lowering a ladder to the next floor. As that stock moves in the direction, you ratchet up that stock or option price stop loss to capture the increasing profit. So a trailing stop's only going to reset higher. It will not move down. So it's a one-directional type of stop loss. Stop alarm. A stop alarm is held by the broker as well. The difference is if the stock should trigger at an alarm price, the broker is directed to call the trader to ask for instructions or an alert to be sent to you to exit that trade. Now, you will see in some older legacy trading platforms the stop alarm exists, but really the stop alarm is all but gone nowadays. This was more prevalent when stockbrokers actually placed trades for you via the phone. But now with all the electronic trading, I'd be surprised if you came across anything with a stop alarm setup, but still wanted to make you aware of it just in case you came across it. Okay, so let's recap your second lesson summary. So we went over understanding stock market basics. We talked about the exchanges, what the exchanges are. We talked about the ticker symbols, so you understood that. We got into bid and ask. We talked about market sectors and subsectors. And then we also got into market terminology and walked you through basic market terminology as well as the types of orders that are going to be available to you as a trader. Now that wraps up our second lesson. We will see you back shortly for the third lesson.